The amount of money in your bank account does not just change what you can buy. It changes how you think. It changes who calls you. It changes what risks feel reasonable. It changes the color of the world. Two people can walk into the same grocery store, look at the same price tag, and have completely different physiological responses. One person's pulse barely moves. The other feels a quiet tightening in the chest. Same number, completely different reality. That is not a motivation speech. That is neuroscience. Financial stress activates the same parts of the brain as physical pain. Money, or the absence of it, is not abstract. It is biological. So today, we are going to walk through the levels, not to make you feel bad about where you are, not to make you worship where you want to be, but to actually understand what life looks like, mechanically, psychologically, and structurally, at each stage of the bank account, because most people have only ever lived one or two of these levels, and that limited experience quietly shapes every financial decision they ever make. Let's start at the bottom. $0, or close to it. You already know what this feels like, or you know someone who does. But here is the part that does not get talked about enough. Living at zero is not just uncomfortable, it is cognitively expensive. There is a concept researchers call bandwidth tax. When your mind is consumed by scarcity, by the question of whether you can cover rent this Friday, your available cognitive capacity for everything else shrinks. Planning, creativity, long-term thinking, all of it gets crowded out by the immediate urgency of survival. This is why the advice, just make better financial decisions, lands so badly for people at this level. It is like telling someone to write a symphony while a fire alarm is going off in the room. Technically possible, practically absurd. At zero, every financial system works against you. Overdraft fees punish you for being poor. Payday loans charge you the equivalent of 300 to 400% annual interest because you need $200 for 4 days. Without a credit history, you pay more for car insurance, more for apartment deposits, sometimes more for phone plans. The system is not neutral at this level. It actively extracts from people who have the least. The psychological weight is its own tax. Decision fatigue hits earlier. Shame is a constant low hum, and the future feels less real, not because poor people are short-sighted, but because when survival is the priority, the future is genuinely a luxury. Now move up a little. $1,000 to $10,000? This is the level most people call getting by. And for a brief moment, it feels like breathing again. But here is what is actually happening at this level. You are one event away from zero. One car repair, one medical bill, one missed paycheck. The buffer exists, but it is thin enough that you can see through it. The average American, as of recent surveys, cannot cover a $400 emergency without borrowing or selling something. Pause on that for a second. $400. That is one broken radiator, one unexpected vet bill, one minor dental issue. And for the majority of people, that amount is enough to destabilize the entire month. At this level, something interesting happens psychologically. People start making small, irrational financial decisions that feel entirely rational in the moment. They avoid looking at their bank account because the number is anxiety-inducing. They spend on small pleasures, a meal out, a streaming service, a cheap jacket, not from stupidity, but from a very human need to feel some control and joy inside a system that mostly feels out of control. It is called present bias. The future feels uncertain, so the present gets overweighted. And the financial industry, with its perfectly engineered apps and one-click purchases, is very good at monetizing exactly that impulse. $10,000 to $50,000 saved. Now, we are in what most people would call stable, and they would be partially right. At this level, the emergency fund actually functions. You can absorb a bad month without spiraling. You might start investing a little. You have enough slack in the system to make slightly longer-term decisions, The fire alarm in your head gets quieter. But something else happens here that is less talked about. Lifestyle inflation kicks in almost immediately. The moment people feel financially stable, spending tends to expand to fill the new space. Nicer apartment, newer car, more frequent dinners out. Subscriptions that seemed extravagant before now feel like basics. This is not a character flaw, it is human nature, and every marketing department on the planet is engineered to accelerate it. The dangerous math here is this. Most people at this level feel like they have made it, while simultaneously failing to build the asset base that would actually protect them. They have income. They do not yet have capital, and there is an enormous difference between the two. Income is what you earn. Capital is what works while you sleep. At $50,000 saved, you are almost entirely dependent on your continued ability to show up and produce. One health crisis, one layoff, one industry disruption, and the buffer disappears faster than it accumulated. The people who eventually escape this level are not necessarily the ones who earn more. They are the ones who figured out, earlier than average, that spending stability is not the same as financial stability. $100,000, the number that feels like a milestone. And it is, but not for the reasons people think. At $100,000 saved or invested, compounding starts to become visible. If you have this sitting in a diversified index at historical average market returns of around 7% annually after inflation, that money is generating roughly $7,000 a year, just existing. You did not work for that $7,000. Time and the market did. Now, $7,000 is not life-changing, but it is a proof of concept. It is the universe demonstrating a mechanism, and people who reach this level and actually understand what they are seeing tend to behave very differently from people who see it as just a number. The uncomfortable truth about this level, though, is that it is deeply median-dependent. $100,000 in savings means something completely different in rural Ohio than it does in London or Mumbai or Sydney. It means something different at age 25 than it does at age 55. At 25, $100,000 is a rocket launch. Time is the most valuable asset on the planet, and at that age, you have decades of compounding ahead of you. At 55, $100,000 with no other assets is a quiet crisis, wearing the mask of a success story. Context matters. The number is not the story. The number plus the age plus the trajectory is the story. Now we go somewhere most people only read about. $500,000 to $1 million. At this level, the structure of life begins to change in ways that are difficult to explain to someone who has not experienced it. It is not just that you can afford more things. It is that your relationship to risk fundamentally shifts. Below this level, most financial decisions are defensive. You are protecting what you have, or trying to stop losing it. At this level, for the first time, capital starts creating options rather than just cushions. You can take a career risk, start the business, leave the job, because failure no longer means catastrophe. You can negotiate more aggressively because you do not desperately need the outcome. You can wait. Waiting is a luxury that most people never get to access. There is a reason Warren Buffett's famous advice, "Be greedy when others are fearful," only works in practice for people who have capital to deploy when fear is at its peak. You cannot be greedy when others are fearful if you are also afraid. You cannot buy the dip when you are the dip. At this level, the world also starts treating you slightly differently. Banks call you proactively. Advisors materialize. Invitations appear. Some of this is genuine service. A lot of it is structured extraction wearing the costume of privilege. The wealth management industry collects roughly 1% of assets under management per year as FEEs. On $500,000, that is $5,000 a year for someone to essentially put your money in funds. You could have accessed yourself for a fraction of that cost. The rich pay for access. Sometimes that access is worth it. Sometimes it is the most sophisticated poverty in the world. $1 million, the mythological number. The cultural finish line. Here is the quiet irony. Most millionaires do not feel like millionaires. The number sounds enormous in the abstract. In practice, if you have $1 million at 65 and you expect to live for 25 more years, and you apply the standard 4% withdrawal rule that financial planners have used for decades, you are living on $40,000 a year before tax. That is a decent income. In many parts of the world, it is a good income, but it is not the private jet, second home, permanent vacation that the cultural image of millionaire tends to conjure. The illusion is partly mathematical and partly generational. $1 million in 1980 is the equivalent of roughly $4 million today after inflation. The number has stayed the same. The world has not. And yet something real does happen at this threshold. The psychology of money starts to invert. Below this level, most people's relationship to money is about accumulation, getting more, protecting what you have. At this level, the central question often shifts. Not how do I get more, but how do I make sure I do not lose what I have? This is where behavioral economists have found something fascinating. The pain of losing a dollar, psychologically, is roughly twice as powerful as the pleasure of gaining a dollar. Loss aversion does not disappear with wealth. In many cases, it intensifies, because now there is more to lose. $5 million. This is where the rules change. Not because of any magic in the number itself, but because of what it represents structurally. At $5 million, invested conservatively at 5%, you are generating $250,000 per year without touching the principal. The average household income in the United States is somewhere around $75,000. At $5 million in assets, you are generating 3 times the median household income while doing nothing. The math has escaped gravity. This is what people mean when they talk about generational wealth, not the feeling of being rich. The structural reality that capital is now producing at a rate that exceeds what most people can earn through labor. The feedback loop is complete. Money makes money faster than work makes money. And this is the part that most financial content refuses to say clearly. The gap between the top and everyone else is not primarily a gap in intelligence, work ethic, or even luck, though all of those play a role. It is largely a gap in compounding time and starting capital, which is mostly determined by who your parents were, not what you chose, not what you deserved. That is not cynicism. That is the data. So here is where we land. Every level of bank account comes with its own physics, its own cognitive environment, its own blind spots, and its own invisible tax. The people at zero are taxed by scarcity and stress. The people in the middle are taxed by lifestyle inflation and the illusion of stability. The people near the top are taxed by complexity, access, and the quiet fear of losing what they built. None of these levels are as good as they look from below. None of them are as bad as they feel from inside. But all of them are more structural than personal, more systemic than moral. And maybe that is the most important thing this video could leave you with. Your bank account does not measure your worth, but it does measure your options, and options, it turns out, are almost everything. The real question, the one worth sitting with, is not how to get from one level to the next. It is whether the level you are chasing will actually give you what you think it will when you arrive. Most people never stop to ask. Most people never find out.